think this could be the year where the Americans effectively lose control over the price.
Are you tired of overpaying for your gold, silver, and platinum bullion coins and bars? Then visit sdbullion.com today. SD Bullion was recently named the 177th fastest growing company in the United States by Inc. magazine. This is because they offer the absolute lowest prices in the industry and follow up with over-the-top customer service. So what are you waiting for? Go to sdbullion.com today and join more than 60,000 happy investors that save money on every precious metals purchase they make.
Hey everyone, this is Elijah Johnson with SilverDoctors.com, and back with us today is our London analyst, Alasdair MacLeod from GoldMoney.com. Alasdair, thank you so much for joining us today.
That's my pleasure.
All right, now a piece you're actually going to be writing on Thursday, or posting on Thursday, you go over your outlook for gold in 2018, and I believe it also has to do with that you're very bearish on the dollar right now. Can you discuss your outlook for gold in 2018?
Yes. What I'm concentrating on in that article is the dollar aspect, because obviously if you're pricing gold in fiat currencies, and particularly in the dollar, it's the fiat currencies that matter rather than gold itself. I'm not suggesting that the value of gold is necessarily going to skyrocket, but what I do see is fairly soon into 2018, my guess is that the dollar will weaken substantially. There are a number of reasons for this. I think the first is that if you look at what the White House is doing in terms of economic policy, I really don't see this as being a successful economic policy. What they're doing is they're becoming isolationist. They reckon that by putting in trade tariffs and restrictions on imports or whatever, doing away with trade deals, free trade, they're getting away from free trade. This is government intervention. It's a tax on consumers. It's also a tax on production, because anybody making anything in the United States has to import the raw materials to produce something. And so if they turn around, for example, and say, we're going to ban the imports of Chinese steel, or we're going to put a 300% tax on Chinese steel, then the Chryslers of this world, for their plants in America, are going to find that their input costs rise, and suddenly they can't compete the market when it comes to selling motor vehicles. So you can see that it's actually a big mistake to go down the route of tariffs and trade restrictions. And one of the things I point out in my article is that we do have a precedent for this, and that is the Smoot-Hawley tariff legislation of 1930. That contributed very much to the collapse in the global economy in the early 1930s. And at that time, of course, it was responsible, partly responsible for driving prices right down. But the reason it drove prices right down was because prices were effectively in gold. I mean, you could convert your dollars into gold. So you had sound money. And so with prices actually collapsing, this time round, it's not going to be like that, because the dollar will be managed downwards along with prices to ensure that prices don't fall. We saw that with the last financial crisis when the Fed stepped in and effectively wrote an open check to stop prices falling. So the whole situation, I think, in terms of the domestic economy, really doesn't make an awful lot of sense if America is going to continue to be a major player in the world economy. And more importantly, of course, its currency is the reserve currency, and it is the primary trade settlement currency around the world. And if America is going to cut herself off from international trade, you wonder why on earth the dollar has any status in international trade at all. So you can see, in a sense, that the direction of travel is for the yuan to gradually take over the role of the dollar, this could accelerate quite significantly in 2018, particularly since the Chinese manage the yuan rate against a basket of commodities. So if, let us say, commodity prices fall, the yuan goes down with it, and that's what actually happened until 2016. After 2016, commodity prices started rising, the yuan went with it, and the yuan therefore went better against the dollar. So what I would see is that there are two drivers here. You've got, first of all, the underlying rate of the yuan against the dollar, which looks like it is going to increase for the reasons I've just said. And the second thing is that by doing away with the dollar in its trade, China is really going to be pushing the dollar down. Now, the question is, at what pace does that happen? And this is where the futures contract, where oil exporters to China can sell their oil for yuan, that is the thing that matters. The futures exchange is already set up and ready to go. All it needs is for the government to say, go.
Definitely, and I was interested in discussing about that, that yuan-denominated oil's futures contract, because, it seems like this might be rolling out before Christmas.
Well, it could be. There was an article, I think, on Zero Hedge to the effect that that was possible. But we're so close to Christmas, I think it would be a bold man to make that forecast. But I think it's going to happen earlier rather than later. And my reasoning on this is that if the Chinese don't do it, there are other markets that will do it. And bear in mind that there is a yuan gold contract, futures contract, in Dubai. Now, Dubai, which really does want to be a financial center, I would have thought, would be very keen, given that the oil is all being exported from around it, to set up a matching contract so that Iran, for example, could use the two contracts in order to put part of its sales into China directly into gold. So, and another important point, which I found people don't actually fully appreciate, is that the gold that is bought through deliverable futures does not come from China, and it does not come from the Chinese population. It has got to come from the international markets, because the Chinese population, you've got exchange controls. You're either in domestic yuan or international yuan. These are international yuan, and anything that's done is international, and it doesn't come out of China. So you can see that the introduction of this contract could actually put an enormous extra source of demand into the physical gold market. And interestingly, they have driven the price of gold down on the COMEX futures exchange in order to get their books balanced by the year end. I'm talking about the bullion banks. They have broadly managed to achieve that. And I think that was necessary, because going into 2018, anyone who is short of gold futures, I think, could find themselves in deep, deep trouble.
Now, do you think this physical demand for gold, the increase in this physical demand for gold, could threaten the kind of gold price manipulation? Do you think this could be one of the steps towards the end of gold price manipulation?
Yes, I certainly do. Gold manipulation on the futures exchange is a thing which has really been very much under American control. London has gone with it because it suits London. They've rather regarded gold as a wonderful form of collateral for a carry trade. That's how the whole thing started. But as far as America is concerned, America, ever since the Nixon shock in 1971, has tried to suppress gold and tried to persuade all of us that gold is no longer money and that the dollar is money. The problem is that not all of us accept that the dollar is money. We accept it as a currency, of course we do, but we don't accept it's money in the genuine sense. Gold is still money. And the Chinese, by cornering the physical gold market, in effect can force that truth back on the American economy and, if you like, the American financial system and the global financial system, which, after all, buys all its commodities priced in dollars. So any move, I think, in the direction which we're talking about I think, which is bad for the dollar, is going to be very, very good for gold. And I think this could be the year where the Americans effectively lose control over the price.
So what does that mean then for the gold price? I mean, I assume that means much higher prices of gold. But like, if there wasn't any manipulation now, what would be really the true price of gold?
Well, we honestly don't know the answer to that one. We can have wild guesses, but there's no point in having wild guesses. All I would say is that if it hadn't been manipulated downwards, then I think the price of gold would be significantly higher. I don't think that matters so much. I wouldn't concentrate on that. What I would concentrate on is the prospects for the dollar. Now, if I'm right and the dollar is likely to go down significantly this year, driven partly by its displacement as the single most important trade settlement currency, then on that basis, I think that gold will go considerably higher. I mean, I wouldn't be surprised to see it at the end of 2018 at over $2,000. But I mean, how fast it moves, I think, is going to depend on how fast the dollar goes down, and that is the crucial thing, which we've got to watch, in my view.
Definitely, and looking at just how the Fed raised interest rates recently, do you see again in 2018 the Fed raising interest rates if we see like the dollar start to inflate again?
Yes, I'm sure they will. They'll have to raise interest rates. And here is one of the myths which I think we should try and explode, and that is that the idea that rising interest rates in a fiat currency is bad for gold. It is not. The history quite clearly shows that when you get rising interest rates in a fiat currency, gold actually goes up. Now, the reason for this is that the central banks are always behind the curve. They are always reluctant to raise interest rates. And this time in this credit cycle is no different. If anything, it's even reinforced because the very high level of debt in the global economy and, if we just think in terms of America, the very high levels of debt basically mean that if they raise interest rates maybe by 2 or 3% in total, that actually could derail the whole credit cycle and bring about bankruptcies, which threaten the whole banking system. The Fed is very much aware of this and therefore doesn't want to have to raise interest rates in order to trigger that point. But if price inflation starts rising, in other words, the purchasing power of the dollar starts falling due to external events and also due to the fact that America has become isolationist in terms of its trade policy, then the Fed has got very little alternative but to sort of raise interest rates probably too late, and it'll find that gold is bounding ahead the whole time, sending a message that this isn't working. So, I would see interest rates, but I really don't think that is bad for gold. If anything, I would expect gold to rise when we see those interest rate changes. And indeed, from 2015, 2016, and now possibly in 2017, the point where gold has really turned has been the December rate rise.
That's very interesting. And I know, I mean, not to get too off topic about the precious metal prices, but like regarding the interest rates, it's kind of interesting because one of the reasons the Fed wants to, raise interest rates, people have said, is because they want to have kind of a buffer. If another crisis hits, they want to be able to lower interest rates. But with interest rates so low right now, if another crisis hits, they really don't have much they can do.
They don't. I mean, where do we start with this one? Their grasp, if you like, of what I would call classical economics is almost zero. They think that raising and lowering interest rates actually does sort of manage demand for money. It doesn't. What it does is it changes the allocation of money between cash and, term loans. And I mean, we found, for example, when Volcker raised interest rates to 20% in 1981, did the money supply contract? No, it didn't. It continued expanding. Indeed, the Fed is basically pursuing the same monetary policies as the German central bank did after the First World War. and there is no escape from it.
All right. Well, Alasdair MacLeod, before we let you go, did you want to share with the viewers any last thoughts you had and where they can find you online?
Well, you'll find me at goldmoney.com. If you go onto the site and you sort of hit the research heading, you'll find insights. I do an insight article every Thursday. It's posted usually a sort of early afternoon, if you like, New York time. And I do a market report also. That's on Friday. And that, again, is posted round about midday on New York time. So those are the two articles I write on a weekly basis.
All right. Once again, Alasdair MacLeod, thank you so much for joining us here today.
That's my pleasure.